and welcome to Macros with Mythili, the ET Now show that takes a hard look at all the major macroeconomic issues and developments in India and overseas. This week we're going to take a hard look at, well, what else but the rupee? How is one to make sense of it all when the currency starts behaving almost like the Sensex? As economists, we want to try and rationalize the appreciation of the rupee by over 6% in the last quarter. But the explanation is really so simple. Why was it not so obvious to even the smartest of currency dealers earlier? Did anybody think that the rupee would dip to below 65 to the dollar when the year started? Remember, late November 2016, it had touched 68.72, and with Trump in the saddle, it was expected to depreciate further. To help us understand and explain what's happening, join the dots as it were, I have with me two of the best brains on the subject, Ananth Narayan, Standard Chartered Bank, and Sajid Chinoy, JP Morgan. Ananth, Sajid, please excuse me for skipping your precise and very impressive designations for our viewers. Suffice it to say that they're both experts in the markets, and markets hang on to their every word. Welcome to the show, both of you. Sajid, John Connolly, the former US Treasury Secretary, once famously said, "Our currency, your problem," when someone complained about how the movements of the US dollar were impacting other currencies. Given the preeminence of the dollar, the rest of the world has learned to live with that. But what does one do when it becomes a case of our currency, our problem? Or it's a strengthening of a rupee, not a problem at all, not even when its strength has nothing to do with the underlying macroeconomic fundamentals. Sajid?
Mythili, you asked a number of great questions over there, so let me try and unpack this a little by little. So yes, in fact, the rupee has appreciated, but that is no different from what's happened around the world. And I think the underlying genesis here is that nobody expected in 2017 for the dollar to actually weaken, for US rates to come off. And the combination of that and the fact that you've seen global reflation play out, we've had nominal GDP growth in the global economy at 6% for the first quarter. In fact, it has happened for 2 consecutive quarters, which is the highest in the last 2 years. So the fact is the conditions for a risk on have been laid around the global economy. There's a sense of some kind of Goldilocks outcome where global growth picks up, and yet central banks will be more restrained. I am personally more skeptical of such a Goldilocks equilibrium sustaining, but that's in fact what markets have priced in. Now, the upshot of that is you've seen most emerging market currencies appreciate quite sharply against the dollar, and the rupee is no different. Now, if you then ask me, what's the implication for India? I would say from a competitive standpoint, let's not obsess on the bilateral rupee-dollar rate. What matters for policymakers, for Indian exports, for Indian imports, is the trade-weighted basket. And I'm going to take a slightly contrarian position and say that, India's real effective exchange rate, at least in the last 2 years, has been growing much more modestly than the rupee-dollar rate would suggest. It's grown about 2 to 3% a year. And I would argue that's not that far off from productivity differentials. So I'm not in the camp that believes just by looking at the rupee-dollar rate that the rupee is grossly misaligned and therefore overvalued. I think the reality is much more nuanced. And I'll make a final point. I think, given what's happening with domestic liquidity, the central bank is caught in a little bit of a bind, because when you have global risk on and all these capital flows coming in, there is no free lunch. Either you let the rupee appreciate and risk competitiveness, or you intervene. But intervention also has costs here, because we already have this huge gush of interbank liquidity. If I intervene in the spot market, I'm exacerbating the liquidity. If I intervene in the forward market, I'm pushing up forward premium, and beyond the point that creates its own distortion. So I think it's a very complex set of global and domestic currents that have come together in the last 3 months.
Absolutely. The reality is always much more nuanced than what most people would believe. But Ananth, the fact is that many people, especially the political class, see the strong currency as something very marshu. Never mind that the strength might vanish with the next puff of wind, in fact, whenever the flows reverse. And how long can we have a situation where internally, because of inflation, the rupee is weakening, and externally it's strengthening? Ananth?
Yeah, Mythili. So look, you again asked a whole host of questions. Let me give my take on the whole issue. I do agree with Sajid that this has been a global trend, and the fact is dollar has weakened contrary to popular expectations this year, and therefore emerging market currencies, including the rupee, have done well. But the fact remains that INR actually has outperformed many of its peers, and this is for both domestic as well as global reasons. On the domestic front, rupee has been particularly the beneficiary of a lot of positive sentiment, with the UP elections coming through, with progress in GST, which is a great set of reforms coming through, with the possibility of a rating upgrade coming later in this year, all that has contributed to a positive sentiment around all asset classes in India, and the rupee has also benefited. Now, the other thing which I think has also benefited the rupee is the fact that interest rates have gone up in India since December of last year. And this is not just the longer end rates, but also the shorter end rates, including forward premia. Now, that in turn has brought in portfolio inflows, and we've seen extremely robust portfolio flows come in particularly in March, and that trend seems to be continuing even in this month, chasing the yields in the debt side on the longer end. And at the same time, because forward premia has been higher, we've also seen exporters rushing in to hedge, given the strength in the rupee and the high forward premia, whereas importers and people who have taken loans in foreign currency have stayed away from hedging. Now, all this has meant that the unhedged exposures in the country have probably gone up during the course of this quarter. So it's a combination of both, positive factors impacting sentiment and positive sentiment towards the rupee, plus unhedged exposures going up. And therefore, the rupee has outperformed. Now that, as you rightly said, popular opinion in India is a strong rupee is good for the country and is a reflection of the strength of the country. I'm not such a believer in that particular paradigm. While I agree with Sajid that the RER tends to exaggerate the extent of overvaluation, I think the fact remains that while exports are inelastic to dollar rupee movements, on the import side, we import about $60 billion worth of manufactured products from China and Hong Kong, despite our underemployed workforce. In the last 1 year, the yuan has actually weakened by about 10% or 9% against the rupee. And that's not good news for either for Make in India or for Make for India. So personally, I think a strong rupee on the back of portfolio flows chasing high interest rates and on the back of unhedged exposures is actually bad news for domestic industry. And something that we ought to be worried about.
Absolutely. And Sajid, that really brings me to another question that's always kind of worried me a little bit. Because old school economists, and I'm definitely old school in that, like to believe that a currency that moves in response to trade flows is far better, at least it's more stable than one that is driven by capital flows. Do you subscribe to that view? Or is that really a relic of the past, and exchange rates being determined by global capital flows is a given and there's nothing that you can do about it really? Sajid?
The fact is, Mythili, that you're exactly right. That over time, as you've seen more and more globalization of capital flows, and many of these capital barriers being broken down, at the highest frequency level, the exchange rate really is a random walk. But if you were to go at the monthly level, for example, capital flows have a much greater bearing on currency movements we find than a more sluggishly evolving trade surplus or trade deficit. I think the question, however, from a policy perspective is to separate the stable flows from the volatile flows. And what we find is that India in that sense has become much more insulated from global shocks. If you go back to 2013 at the time of the taper tantrum, what we found was our current account deficit was about $90 billion, 88 billion to be exact. Only 20 billion of that was financed through FDI. Portfolio flows were financing 27 billion, or 1/3 of the current account deficit, and that's why we were so vulnerable, because at the first hint of a sudden stop, you saw the BOP come under significant pressure and the rupee come under very significant pressure in the summer of 2013. That's completely reversed right now, in part because we've been the beneficiaries of this very favorable terms of trade shock through lower oil prices. The current account is trading close to $20 billion, or 1% of GDP. And net FDI flows have been tracking twice that level, 38 to 40 billion. So in a way, FDI is over-financing the current account twice over, and we've become much less reliant, or not reliant at all, on portfolio flows. In fact, until early this year, we've seen portfolio outflows last year, the year before, much of this year, and that didn't affect the rupee at all. So I think, from a policy perspective, what you want to do is build buffers. What comes in can so equally and easily go back out, and you want to separate from the more stable flows that are likely to endure and versus the more volatile flows, which is what you want to guard against. And I think the fact that the RBI has been intervening opportunistically over the last 3-4 years to build up its FX reserves is precisely to guard against the situation implied in your question, which is if volatile money comes in and were to reverse, are there sufficient buffers in place? And I'm happy to note that that there are. I'll just make one very, very quick point. I think Ananth makes a very good observation. We've been saying this for a long time as well, that the 36 country trade weighted real exchange rate is masking some bilateral imbalances. The fact is the rupee has appreciated almost 10% in real terms against the CNY, and China's weight in a 36 country basket, I would argue, is less representative than the risk China poses to manufacturing exports. So that's one area of concern. But broadly, if you just step back and say, through all the noise, there was a structural break around 2014-15. Till then, the nominal effective exchange rate, what the RBI can actually control, was very volatile. In the last 2.5 years, what you're seeing is a central bank that's kept that trade-weighted rate broadly flat, such that your real rate appreciates by your inflation differential, and to the extent that you've got some productivity growth as well, one can be a little bit less concerned of systemic overvaluation, even though again certain countries and currencies is very much a concern.
Sajid, I'm not really sure how much central banks can really control exchange rates. But Ananth, are you as agnostic about the underlying reasons for a currency's movement? Remember, we're talking about a poor country where hedging not only adds to costs, but many of our smaller exporters and importers really don't have access to sophisticated tools to hedge their foreign exposure. And dare I say, it may even be taken for a ride by dealers looking to make a quick buck. And that's not an insinuation at all, but it's a reality, as we've seen with some of the biggest names in banking in recent years. Ananth?
Okay, Mythili, I'm not agnostic to the nature of the flows and the accretion to reserves, etc. I agree broadly with Sajid's point that the nature of trade and capital flows is very different now than it was in 2011 through 2013, and clearly a lot more benign than it was then. Having said that, what does worry me is while the terms of trade are much better and the capital flows through net FDI is a lot more robust, I'm also sensing a lot of unhedged foreign currency exposures being built up over time, which is also accreting into the RBI's coffers. In fact, we did this analysis since 2014 of comparing the actual intervention done by RBI in the spot and forward markets vis-a-vis what they should have actually mopped up in the markets, given what's coming through a current account deficit or through net FDI, or maybe through portfolio flows into equity. See, all of balance of payments ought not to accrete to RBI's coffers. Flows that come in through ECBs, for instance, or I would argue even FPI in debt, should be hedged in the market and should not accrete to the RBI's reserves. If you go through that analysis, since the last 3 years, it appears that the net unhedged positions in the country have gone up by $70 billion. Now, that's not a healthy sign, and a strengthening currency on the back of these kind of unhedged currency exposures being built up is not a good sign at all. The last point I would make is, whichever way the flows come in, through capital flows or through exporters hedging, over-hedging, importers not hedging, or through FPI flows coming in unhedged, the question comes about as to what RBI's stand should be as far as intervention is concerned. Should they hold the rupee at a particular level? Should they buy in spot and forward and so on and so forth? And that's a policy issue which still needs to be debated. The fact is, again, I'm old school as well, Mythili, just as you are. And the whole point about the impossible trinity or the trilemma comes to point again. The moment we have an independent monetary policy which is focused primarily on inflation and therefore warning of inflation shocks and building up interest rates or allowing interest rates to trudge up, and when you have by and large free capital flows or room for capital flows to come in, then a stable currency becomes an impossibility. Now, which means that RBI has to do a certain amount of intervention. And I would argue that given this imbalances that we have with specific countries, especially with countries like China, there is a case for RBI to ensure that there is robust intervention in the spot markets, not in the forward markets, so that exporter selling also subsides at some stage, and to hold the rupee at a particular level, and not allow the larger economy to kind of go under because of an overly strong currency.
Absolutely. I would think so too, because ultimately the financial sector and the real economy have to be linked. But on that note, it's time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're trying to make sense of the rupee's movement. Is it for real? Is it valid? Is it sustainable? So let me now turn to Sajid and ask you, Sajid, the question. Post the global financial crisis, faith in the infallibility of free market forces has been somewhat tempered, at least so I'd like to believe. Would you agree? And if yes, should the central bank intervene a little bit more aggressively to bring rates in line with the underlying fundamentals? Yes, today it might add to the RBI's headaches on the liquidity front, but assuming that there are other and maybe better ways of managing liquidity, is there a case for greater intervention? After all, you can intervene relatively more easily in the context of an appreciating currency than in the context of a depreciating currency, because there you have a limit of depending on your holdings of foreign exchange. So even though RBI says we'll intervene only to curb volatility, should the RBI look a little beyond that, Sajid?
Mythili, I'm going to actually take a contrarian position and disagree with both Ananth and you on this. I think the implication of the impossible trinity is that the ability of the central bank to intervene is less and not more. We all want an ever-increasing capital account liberalization, of course with adequate prudential norms here, but we are a country where we will run a current account deficit. Investment needs to be higher than domestic savings, so we will need more and more foreign capital. We all agree that we want an independent monetary policy framework, which then means that India cannot also then have a fixed exchange rate. And so the point is that the impossible trinity itself necessitates that you cannot control the exchange rate in a pre-designated equilibrium level, so to speak. And when there are pressures to appreciate, you should let the rupee appreciate. When there are pressures to depreciate within bounds, you should let the rupee depreciate. That's essentially what the trilemma tells us. Now, what the central bank can do is temper the volatility so that we don't get too much misalignment from what we perceive to be the underlying equilibrium exchange rate. So number one, I would argue that if we want a capital account and we also want independent monetary policy, we cannot then expect the RBI to quote unquote fix the exchange rate or stop appreciation or stop depreciation within certain bounds. Number two, I actually think a little bit of volatility, two-sided volatility, is very healthy. I think it's healthy for market development, for market structure, and I think it's healthy for prevention of more unhedged foreign exposures, because the more the rupee is seen as a one-sided bet and the less volatility there is, the less the incentive, I would argue, to hedge. Number three, even if the central bank wants to intervene, if you intervene in the forward market, you push up the forward premium and you could disincentivize some hedging. If you intervene in the spot market, you're creating rupee liquidity concerns which could interfere with your monetary policy framework. And lastly, Mythili, even if we did think there was a more efficient way to intervene and you didn't believe in the impossible trinity, ex ante forecasting what the quote-unquote equilibrium level of the exchange rate is really a mug's game. The equilibrium underlying rate is not a static concept. It's a dynamic concept. Equilibrium exchange rates depend on a variety of macroeconomic variables, most of which are not easily observable.
Yes, it's true. No central bank is an oracle and can never know exactly where the rupee should be. But my question really was that should it not bear some relation to the underlying? When you have a 6% appreciation in a quarter, that's a huge amount. So is that enough? In fact, Ananth, if you remember last time in 2010 when we saw a similar influx of dollars, there were lots of demands for intervention. And I'm quoting from an article that Shankaracharya, the very noted economist, wrote then in September 2010 when he said that since 2009, RBI appears to have deliberately adopted a much less interventionist stance in line with the free market doctrine. If this is true, it comes at a time when empirical research is increasingly supporting the more eclectic and interventionist approach to exchange rate management that stood India in good stead for 15 years and would constitute a serious policy error. How is it that we see very few economists nowadays calling for more aggressive intervention? Is it because we've accepted that once we move to a market economy, intervention is a no-no, Ananth?
So I'll give you my take on this, and Sajid does make some valid points. I'll tell you what my take of the impossible trinity or the trilemma would be at this particular stage. I agree with Sajid that we do require capital flows, and therefore putting curbs on capital flows is really not an option. So that leaves you with what happens to short-term monetary policy and what happens to the dollar rupee itself. Now, if I look at a couple of factors, one is that while there is a considerable amount of uncertainty on global factors and what could happen to our own economy going forward, in the medium term, the reality is in the short run, our credit offtake, including the growth that we are seeing in capital markets, is abysmally low. It's extremely tepid. So there just isn't enough credit offtake or activity happening in the short term. And the second observation is dollar rupee has been coming down, rupee has been strengthening to a point where it looks to be a problem and is begetting more hedging flows. As I repeatedly said, one of the issues that I'm seeing as a financial stability issue is the issue of unhedged foreign currency exposures. And what happens, I kind of don't entirely agree with Sajid's point that a volatile currency, one-sided volatile currency will beget more hedging. At the moment, for instance, in the midst of all this rupee frenetic rally, I'm really not seeing importers coming in to hedge. I'm really not seeing people who've taken ECBs coming in and hedging. All I'm seeing is a bunch of exporters who are waiting for upticks in dollar rupee to hedge more. And I suspect that's actually adding to the issue that we've had over the past 3 years of unhedged exposures going up. So if I look at these two particular points, the fact that the economic activity in the immediate perspective is looking extremely tepid, notice the credit offtake, and the fact that rupee is strengthening on the back of unhedged exposures going up, I would argue that the choice between the trilemma is actually to have short-term rates reasonably low and allow rupee to therefore stabilize.
But Sajid, do you think that the RBI's new positioning as an inflation targeter is actually making it more hesitant to intervene against a strengthening currency? After all, a strengthening currency does keep inflation down. And if you remember that old quip, if all you have is a hammer, then every problem begins to look like a nail. Likewise, if you are essentially an inflation targeter, then you're bound to lean on anything that is going to keep inflation down. And is that the reason why the RBI is not doing it? And does it in a way, the appreciation of the rupee, does it really amount to monetary tightening when the RBI doesn't want to do it through interest rates? Sajid?
So Mythili, I think again we need to step back and first establish the facts, which is that how much has the rupee really strengthened. Again, I would point you to the 36 country trade weighted nominal effective exchange rate, and we don't have the numbers for March just as yet. We can impute them, but if I don't look at March, if I go back to January of 2015 and compare that to February of 2017, which is a 2-year period, the trade weighted 36 country nominal effective exchange rate is just 1.5% stronger. So I think we need to firstly get away with this obsession of the rupee dollar rate and look at a basket of currencies, and what you'll find is that this clearly is an approach, a strategy the RBI is following to keep the trade weighted basket relatively stable. So number one, I'm not even in the camp that believes that you've had all this large appreciation. Now, March could be different. In March, we will likely see that both the nominal and the real rates appreciated potentially meaningfully. But look at the unique circumstances around this. At last count, portfolio flows in March were above $9 billion. That, I believe, is the highest monthly portfolio flow ever recorded in India. So you're seeing this gush of capital come to all emerging markets, and that creates policy headaches for central banks. Precisely because we now have an independent monetary policy framework, and that should take primacy. The exchange rate must therefore become subservient. There are no easy choices. If you let the rupee appreciate too much, we'll worry about competitiveness. If you intervene to prevent appreciation in this environment, either you interfere with your own monetary policy framework by creating more liquidity, or you intervene in the forward market, and as Ananth rightly points out, that creates issue of financial stability. So there is no free lunch here for central banks. The hope is, this gush of capital will slow down to emerging markets as the world normalizes, and things will come back to normal. So number one, I'm not in the camp that believes we've seen this massive appreciation. In trade-weighted nominal terms, the currency has been flat. In trade-weighted real terms, it's up about 5.5–6% in 2 years, which I would say is not crying out for appreciation. Now, your last question of, is the RBI letting the rupee appreciate consciously as a disinflation mechanism? While one can never know what the thinking is, I'd be very surprised by that, because the RBI's own estimates in the monetary policy review is that a 5% appreciation would cause a CPI disinflation of, I think, 10 to 15 basis points. So clearly that would suggest that the risk return here is very low, and so I'd be very surprised if they were doing that. So let me just summarize by saying, when you have this huge influx of capital to emerging markets, This is the classical impossible trinity. Emerging markets would like monetary policy frameworks, they need the capital. How do you cope with this arm? And I would hope A, it's temporary, and B, you kind of muddle through. You allow a little bit of appreciation, you intervene a little bit in the spot market, you intervene a little bit in forward market to ensure that the distortion that you're creating is not concentrated in either financial stability or in monetary policy or in real overvaluation.
Yes, Sajid, you said that you hope things will return to normal, except the only problem is we no longer know what is normal anymore. What is normal? That itself has changed. But I guess this conversation could go on and on. But I'm afraid we really can't run out of time completely. So I'll have to end this discussion now. Thank you so much, Sajid and Ananth, for joining me in the discussion. I'm not sure we've given our viewers the answers that they were perhaps looking for, because typically most people want to know just one thing. Will the rupee appreciate? Will it depreciate? And the honest answer, I'm sure both of you will agree, is that nobody knows for sure. I do hope, however, we've given our viewers a flavor of just what exactly is driving the rupee, at least some of the factors. Thank you so much for watching. Remember, we'll be back next week with yet another edition of Macros with Mythili. In the meantime, if there's any topic that you'd like to see discussed in this program, do write into us at the mail ID you see at the bottom of your screen.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.